we're just getting the financial inclusion sector reports distributed, so that might take a couple of minutes. Meanwhile, I thought we can just get started on the panel. A brief introduction about myself. I'm Jairupa, and I'm from Patamar Capital. Patamar is a venture capital fund that invests in South Asia and Southeast Asia. We typically invest in ventures which identify opportunities, which open up opportunities for low-income households. And financial inclusion is a very big priority. I come from the financial inclusion space, and so do a bunch of my colleagues, which is why it's a big focus area for us. With that background, I'd like to get started on it. This is an interesting topic. It says SDG1, no poverty through financial inclusion. They just couldn't fit financial inclusion anywhere, and so I had to find no poverty to go with it. But yeah, that's the thing with financial inclusion, right? It's not an end goal by itself. It's an enabler. It's the route to reach these sustainable development goals. In fact, out of the 17 sustainable development goals, about 7 of them are enabled by financial inclusion. So you can solve poverty, gender equality, economic growth, healthcare. A bunch of SDGs can be solved through financial inclusion, and which is why it's such an important topic. It's also the first sector which got or which was noticed in terms of impact as something which can be achieved through impact investing. So happy to get going on this. So we've shared this report. I hope everybody's got the report by now. Let me just quickly run through what's there on the report. It's typically, funds haven't reached the segment that most requires financial inclusion, the segment that that needs to solve many of these sustainable development goals for them. That segment, which is the largest segment, has not been able to access financial services. And that's the segment which really needs it. It's a myriad of reasons why they haven't been able to provide or get those services. The government has tried the priority sector and so on. There have been many initiatives over the past, but that's not the one that's solving them, which is why most of us from the industry are focusing on financial services and being an enabler not just for sustainable development growth, but also for business as a whole. This is the sector that's getting disrupted early. So we've run through the regulatory environment for financial inclusion. Anyone who isn't from India would know it's a little confusing, right? There are too many NBFCs, there are types of NBFCs, there are chit funds, there are housing, NHB has these housing finance companies, there's small finance banks, payment banks. So we've tried to give a little bit of a dossier on what the regulatory environment looks like in India. And we've taken a bit of a deep dive into some of these sectors, personal finance as well as SMBs. It's funny that SMBs actually contribute to about 70% of the population's employment. And that population's employment is, that's the reason it's called the engine of economic growth in India. But they don't have access, and therefore you can't grow that. So if you want to solve many of these problems, just solving financial inclusion for SMBs and helping them grow would be a big help. And we've also looked at technology, the role of technology. There's a lot that's happening. The bank accounts have been opened, and we're looking at ways that this would actually encourage financial inclusion. Opening bank accounts is, again, not an end in itself. People need to adopt it and use those bank accounts to get further financial services. And that's where technology comes into play. And we're hoping that that will help the last mile reach as well. So we have an eminent set of speakers here. Let me start with Lorraine. Lorraine comes from OPIC, Lorraine Rodwin, and he heads the financial inclusion for emerging markets in OPIC. He's a very big enabler because funds from OPIC come into different entities in India, both banks, NBFCs, etc., and further come into the ecosystem. Then we have Anuradha. Anuradha is from Omidyar Network. Anuradha and Omidyar have done a bunch of investments in financial services. We have Hardika, who's from Kinara Capital. She is the practitioner here. She is the person who's been on the ground and built a fantastic company. We have Mr. Pawan Bakshi. He is from the Gates Foundation, and he heads financial inclusion at the Gates Foundation. They work closely with the government for policy decisions on financial inclusion. We also have Royston moderating with me. Royston can take over from here.
Thank you, Jairupa. It's great to have so many of you in the room. It's delightful to see so many people staying awake post-lunch. And above all, it's great to have me sitting opposite Jairupa because I don't agree with many things she says. So I think that's a great place to start because she felt that we were force-fitting this topic, financial inclusion with zero poverty, and I don't think there is any other way to be able to meet zero poverty without true financial inclusion. Delighted to have Eriko also in the room. Eriko was with me last week in the UN General Assembly. Good to see you again. And it's a pleasure to have people who are really in decision-making about financial inclusion, but more importantly, those in the trenches working in financial inclusion. And so we're fortunate and blessed to have across this diverse group really interesting perspectives. I just wanted to share with you how important this is, literally coming on the back of the General Assembly, and Eriko and myself were speaking there. We're seeing a momentum like never before, whether it is governments, whether it is corporates, whether it is private wealth, whether it is social enterprises, the amount of momentum, and forget what the fake news tells you, there is real interest to be able to make a difference. And that coming together is extremely energizing and extremely positive. And the ability for us to really ride that wave, not because it's a wave, but because we genuinely want to make a difference, is what is the most fascinating thing of all. I think in that context, therefore, we have today some really interesting perspectives. We have two investor perspectives. We have Omidyar, which comes from an institutional perspective. We have Gates, we have Lauren from OPIC, and we have Hardika coming from the practitioner's perspective. And we want to look at it with a digital lens. It's rumored that Albert Einstein once said that we are making much more progress in technology than we are in humanity. And probably, as the modern Mahatma would endorse, like Vivek said a few minutes ago, do we need to ask ourselves, is there real impact that's happening towards zero poverty in the way we go about financial inclusion? And therefore, it's great to have these perspectives. It's important to have this debate. We've positioned ourselves on either side of the table for an intention to be able to take positions, not to shy away, but to be transparent, at the same time to keep this as inclusive as possible. So I will not talk beyond that, but give it on to Omidyar, who has put together a good study which gives us a sense of where digital financial inclusion is going and some of the fresh perspectives that they want to share with us. 5 minutes only.
Some folks in the back. Do you want to move here? There are some chairs in the back here.
Thank you for giving us this opportunity. We will now, I and my colleague Nilesh, who's here with me, will just like take you over a short presentation which gives a sense of how digital credit, how MSME lending has been functioning so far, and how digitization and formalization is going to impact digital lending. What's the opportunity size, and what perhaps are some of the roadblocks?
Hello everyone, good afternoon. And as part of the study, we along with BCG did a quantitative survey of about 1,500 MSMEs. There were qualitative and focus group discussions of 80 MSMEs, and we also talked to people within the ecosystem like lenders, intermediary, etc. The key findings that we have was that there is and what is the problem statement really, right? We have huge informality within the MSME space in India, and even the formal credit that is given out, almost 40% of that is given in the proprietor's name and not the business's name. And all of this has resulted into what we see on the screen. Almost $240 billion of credit is an unmet demand. Why is this happening? This is happening because many of these businesses thus far did businesses in cash with little paper trail which can be verified. And for smaller, many micro businesses, it is difficult to differentiate between what is a business and what is a proprietor, what is his personal life. And that sort of a differentiation not being there made it very uncomfortable for many of the formal bankers to underwrite, even if we reach them. What is it that is changing in the market? If you look at it, formalization has increased over the past year or so, and as we all know, GST has been a big catalyst for that. However, if you see the increase that we found during our survey, most of it is in the segment of revenue between 10 lakh to 1 crore. There we have seen a 14% increase in formalization. However, this also reflects the challenge going forward because MSMEs, which are now contributing to majority of the informal MSMEs, fall within the range of turnover less than 10 lakh, and GST is not compulsory for people like them. Hence, there need to be other mechanisms through which we would want to get them formal. Why is it that we stress on formalization, right? So formalization, especially which happens through GST, would be able to provide, hopefully when the systems are ready, a good paper trail for underwriting and hopefully monitoring going forward. The other key trend that we see is the reducing of telecom costs, which would then help us sort of enable digital credit. There, thanks to Jio and the subsequent shake-up in the telecom landscape, as you can see on the screen, the cost of per GB of data has fallen dramatically. Even the smartphone costs have gone down by close to 30%. All of this has meant that, especially in the MSMEs, who are slightly better off than the general population, the smartphone penetration has gone up to 85%. And data consumption, like we all say, because of all of this, has increased to about 6.5 GB per month. All of this means that our MSMEs now are there in terms of digital, and hence the adoption of digital credit or availability of digital credit to them may be easier compared to where it was, say, a couple of years ago. The third important thing is the digitization of the MSMEs. If you look at the MSMEs and try and see what is it that is important from a lender's point of view, you would look at how digital the MSME is in terms of either accounting or payments or sales. All of these sort of help the lender underwrite. And in that, we see that almost 47% of the MSMEs are digital in some way or the other. This number may not be that exciting right now, and a 6% increase may not look like a significant increase. But what we have found in our survey is that there is an attitudinal shift. Earlier, when you would talk to a small business, they would say that, what is digital, maybe whether it is useful for me or not, I'm not sure. But now the awareness levels have increased significantly, and they see themselves becoming digital over the medium term. So that sort of a entry barrier into the digital ecosystem, the inhibition towards trialability of these kind of solutions, that is sort of coming down within the MSMEs. So that's good.
Sure. So we were looking at, therefore, like, what does it mean for the future? One of the things, as we were debating about formalization, when Nilesh was actually presenting the increase in the formalization and the almost complete formalization of the MSMEs, the one thing that the study also made clear was that a lot of this was absolutely because it was mandated, right? It was actually like painful for people to formalize. It was not that they adopted it willingly. And the second thing that came out in a less forcible fashion was that to a lot of them, it meant that they did not understand what exactly does it mean to them, right? Now, going forward, what we are trying to look at is what is the impact of, therefore, like this formalization, and how do you create the value of the how do you prove to the MSMEs the value, the micro businesses especially, the value of formalization? So basically, there are three things that we've actually tried to capture in here. One is that, most of them are a part of some supply chain or the other. So there is actually like an inherent data trail that they have. They also have a data trail which is being created around GST and the tax benefits. And some of this data trail, which actually is, and you would see like a big, a number of sources, including the India Stack elements coming in. With the enhancement of the data trails, the ability to underwrite is becoming spectacularly better. So on the one hand, if you looked again at digital lending in the earlier stages, there were two problems. One is of identifying these MSMEs or reaching them, the sourcing problem. Or the second is about even if you do reach them, what do you do with them? Because there is no data trail that you can use. So the second problem is actually pretty close to being solved. Not only are you able to underwrite better because there is better data, there is also much better verification data which is available from multiple sources, which is what you can see in this slide. So what we believe, therefore, it creates is an opportunity for people to underwrite better. And once you have that opportunity, then it translates into roughly about $100 billion. And this is what we expect to happen over the next 5 years. Is this happening? Are there no roadblocks? We also actually, the answer is that that's not necessarily true. We have opportunities across different kind of business models, as you can see. People who are a part of a supply chain, people who are a part of online aggregators. So supply chain would be like the HULs or the Tata Motors suppliers who get greater visibility through the GST data trail. Or the online aggregators like, let's say, the Swiggies or the Flipkarts of the world, who have a network of suppliers with them. So there are people who have data trails in that kind of a way. There are point of sale people with physical machines, card swiping machines, which are also being available, or it could be or it could be actually virtual machines as well. So when you look at these three parts of the chain, it's actually fairly clear that there is an opportunity, and it is also clear that there is a way to reach these people. Right? In that kind of, so as they are a part of a supply chain, you actually can go down the supply chain and it becomes much more easier for people to become visible. With the aggregators and the point of sale as well, it is very clear that it starts becoming really visible. So this part of the opportunity where it's $46 billion, which is approximately half of what we defined as the overall opportunity set, we believe it can really translate. Now the next comes actually the direct digital part of it, right? This is a little bit less clear. There are people who have digital trails, but who are not necessarily a part of any of the formal supply chain. To give you an example, retailers are not necessarily a part of a visible supply chain, right? High street retailers, independent retailers especially, and they constitute a large population. So it is not very clear how they are a part of a formal, full supply chain as such. So how do you reach out to them? So there are certain parts of it, while the underwriting problem is much better solved for, and the visibility problem is also solved for in parts of the ecosystem, some parts of the ecosystem are actually less defined. So we would talk about this more in our report later. So now handing it back to Jairupa.
Thanks, Anuradha. That was helpful. So I have some
Well, I was admiring your report, and I was wondering why it wasn't around 5 years ago or 6 years ago. Because a lot of what you said is where the problem resides, right? And the biggest challenge in the SME or MSME, micro small business enterprise space, largely, as you mentioned, a lot of it was individual lending, and most lenders, if you're, first of all, access to the bank capital, as we all know, is rather difficult. And the non-banks, the way they solve for the individual lending problem is by just capturing the land or property collateral available of that sole proprietor. So then how do you really move the needle from the individual to the business, right? And that was the first challenge that whole business, the first and most important question everyone asks is, what is your OPEX? So the way to combat that came with technology, and frankly, the timing is everything, and had it not been in this last decade, I don't think the business I'm running today would have been successful in that sense. And then the third piece around this is about underwriting. So, okay, you've got now digitization, or you've done the digitization of information. So we have what we call a high-touch, high-tech model. And so we have feet on street that captures the information, but then everything is tech-driven, completely paperless, and completely digitized in its underwriting, with ideas behind how and what we're looking for. And at the end of the day, we still have the human element that we still have to make that final call on. So it sort of gives you the flexibility and yet the rigor that is required. So in terms of funding, when we talk about funding in this space, and there is two types, from my perspective, obviously, the equity funding and then the debt funding. The equity funding in this space really came from social investors. I was listening to Sir Ronald Contour talking about the VCs and just saying, have faith. And I think that's where the impact investors, social investors come in with faith. And had that not been the case, it would not be, if it wasn't for that catalytic capital, nothing could have been launched. The second part of that capital came actually, and I'm sitting right across Dhruv, so from what is Northern Arc, previously known as IFMR. They, in my first 12 months of having launched a business, gave me my first debt, 25 lakhs. I think is the smallest loan they've ever given. But it took that. It took for a lender to see beyond, to see way beyond where the market was going, and be catalytic in their own way, to look at what is needed in this space, to break their internal norms, to make that first move. And so I would say that both these capital sources, whether it's equity and debt, when it came at the right time, really put us into that mix of being able to build something.
Because you mentioned technology and using it in different phases. I'm curious what your thoughts are. Currently, if you look at financial services as a whole, the segments which are currently probably even, or the first steps for someone who is financially excluded are really credit and payments. Bank accounts, I think, I'm counting that as a hygiene factor, but whether they are applicable or not, these two are absolutely essential, credit and payments. You're addressing the credit part of it. And when I look at the credit process, you have, you're probably, customer acquisition can be done through technology, customer validation, credit processing, disbursement and collections. This is the entire process for any credit product. So where have you seen technology play the most part in terms of efficiency? And how do you see it going forward? This is going back to Anuradha's deck, where she had mentioned how digital data is evolving. From my understanding, there are still gaps for us to be able to completely look at a fully automated product. So would love your thoughts on fintech versus financial services.
Well, I think one of the things we need to probably talk about, which we won't have time for in this group or time frame today, is the MSME sector itself is rather large. There are so many layers, segments, subsegments, and frankly, a whole range of types of businesses. So customer acquisition could it be done digitally? Maybe over time for different or specific segments of customers, certainly not the customer that we are going after. Our typical customer is maybe high school educated, done some technical training, runs a manufacturing business or a trading business, and he is not exactly in the universe of technology. The data is actually quite accurate. I mean, we see this in our book as well, is that maybe now 85% of them have a smartphone, right? So, and most of that smartphone is used for WhatsApp. So I'm not sure how you convert that from a social interaction to a business tool. So fintech companies, I think even in India, if you look at, there was a lot of excitement around fintech and for some years. And I think a lot of fintech companies are recognizing that perhaps we can't just take a model that works outside of India and try to slap it on. The uniqueness of India needs to be built into the model. And that uniqueness requires us to adapt that. And a lot of fintech companies have gone back to needing some sort of feet on street for originating and some sort of feet on street for collections. So a large part is what is left in the middle is then underwriting, right? I would say for us, what we use technology for is to actually deliver a faster service. If we were to do this based on paper, which is, if you think of the traditional process, it could take 3 weeks, 4 weeks, 5 weeks to do it. We disperse a loan in 5 days. So our ability to go out, meet the customer, this is still a person-to-person activity, capture all the information, digitize it, but then the decisioning happens really fast and the disbursement, et cetera, happens really fast. That allows us to put the money in his bank account within 5 days. And that's where technology has really been supremely useful.
Great. Thanks for that. And Lorraine, I do have some questions for you. You handle financial inclusion for all emerging markets at OPIC. So, given the status of technology in countries like India, have you seen any example of a country that's adapted financial inclusion well? And if you could elaborate on any such model, that would be great.
Sure, thank you. Actually, I'd like to start by... I think your mic, you may want to start. I'd like to start just by reading a quote by one of my heroes that I think really gets to the heart of what Royston and Jarupa were talking about when you want to get to zero poverty. So the quote is from Senator Robert F. Kennedy, where he was speaking to a university in South Africa. And if the senator were alive today, I'm sure he probably would be one of our allies in trying to reach zero poverty. Each time a man, and I'll add a woman, stands up for an ideal or acts to improve the lot of others or strikes out against injustice, he sends forth a tiny ripple of hope, and crossing each other from a million different centers of energy and daring, those ripples build a current which can sweep down the mightiest walls of oppression and resistance. That's where I'm coming from, and I want to connect with all of you. We're working on financial inclusion in countries around the globe. We've had pretty good success in Peru. Many people here have studied the markets in Peru. I think it's anchored by an excellent regulator. And the regulation is backed up by people who are very good at working closely with the MFI banks and the cooperatives and creating an enabling ecosystem environment for a well-functioning financial inclusion system. It's a very different market from India in many ways: population, geography, the structure of the banking system and the NBFCs. But it's one which I think is particularly noteworthy. The Peruvian financial inclusion industry has driven down costs dramatically. It's among those countries which are best in terms of the interest which is charged on their loan products. So I would commend Peru for what they've done. I would also say, from OPIC's perspective, we've done a lot of work in Cambodia. There are pluses and minuses. I think there are probably people in this room that know the Cambodian microfinance and financial inclusion sector quite well. We're working with a Cleta Bank. We think that they're really an innovator a trendsetter for the industry, the gold standard. And so when you've got a player who is really setting the mark for others, it helps to create a spillover effect where there's innovation throughout the industry. In both cases, however, I just want to warn, issues of over-indebtedness have cropped up. So there can be a complacency, sometimes there's an arrogance, and it's really important to look deeply into how well the product is suited to the customer.
Great, thanks for that. Now that you've shared a little bit about Cambodia and Peru, what is your outlook on the financial inclusion space in India? And if you had to give some suggestions to the regulator here, what would they be?
Great. So I think that the people in this room probably have a much deeper understanding of the financial inclusion sector in India, so I'm not going to pretend that I do. But I will give you the perspective of OPIC, the U.S. government's development finance institution, and why we think this is an excellent market for us to channel capital to enable financial inclusion in India. First, we think that the evolving ecosystem, the financial technology, that excellent report that we just saw from a Midyar network, these are things that we look for in an industry, and this is really something which is quite encouraging to see how people are using technology well as an enabler to reach people in urban and in rural markets. We look for trusted financial intermediaries. We're based in Washington. We can't expect that we're going to know the markets as well as the financial intermediaries here. So we look for partners. Many of them are in this room. It's really quite exciting and humbling to be sitting here with our clients. I won't name them all. You know who you are. But you're the people that we look for to help us channel our capital, our debt, through loans and guarantees to reach the hardest places to reach in India. So we're really excited about the financial intermediaries. I also, quick commercial about OPIC. Many people may know that there was new legislation that was just passed, the BUILD Act. The president signed it into law. Among other things, what it means is that we're going to double our book of business from 29 billion to 60 billion. That is great for India. We had reached a country allocation cap. We can now expand greatly our business in India. And we now, for the first time ever, have the authority to invest equity. We've only had debt ever since our establishment. That means we can invest as an LP in funds. We can directly invest equity in enterprises. So with the right partners, I believe that we'll be able to do much more in India. Now, a word about regulation. Again, I think people here understand the issues much better than I. But I will say that it's been a bit challenging for us in several ways. The ECB route has come with certain difficulties for us. We're a dollar lender. There was a time we could make an ECB dollar loan to many NBFCs. That's no longer the case. So it gets more complicated when we think about how we can find a way to channel rupees to our clients. Second, something which is a little bit arcane, but I feel I must mention it. For reasons which I don't understand, OPIC does not have a withholding tax exemption, even though USAID does, the same US government. What does that mean? It means that our clients have to pay higher interest because we don't have the withholding tax exemption. We'd love to see people lobbying hard, and we certainly have been, to have equity in terms of the whole US government having that same tax exemption. Those are two things that I would leave for now, and would love to talk with other people to get a sense of how you see the regulatory issues. Thanks, Jarupa.
Okay, my third question.
Maybe we should just make sure that other two, because we have already.
Yeah, but this is a question with the fact that this panel or these speakers are equally balanced in terms of gender, and we have, one woman entrepreneur here. I had to bring this up with Lorraine. Lorraine, we've heard about your 2X program. If maybe you could share a bit on 2X program and what needs to be done to see more women entrepreneurs in India.
I'll be very quick about this, Royston, because I do want to give time for the rest of the panel. So 2X is our program for investing in women. investing in women-founded, women-owned, women-operated enterprises, investing in companies that provide products and services, capital, skills, and training for women. We've committed to mobilize $1 billion as a group of 7 DFIs. Most recently at the G7, 7 of us have committed to mobilize $3 billion. We take this really seriously. And so we understand that in financial inclusion, there is a great benefit to women, and through women, benefiting families and communities. Would love to talk more about this later with people when we have time.
Wow. That's incredible. I mean, truly those ripples of hope are becoming waves. So thank you for that, Lauren. It sort of also brings me back full circle in some ways to talk about really the effect on zero poverty. And coming from where I sit as the chair of Sadhan, which is the network of microfinance institutions, we serve today 30 million clients. All 30 million are women, and all 30 million women are at the poverty or at or around the poverty level. So it's very encouraging to have someone like Pawan from the Gates Foundation to be able to give the perspective of really, Pawan, do you see digital financial services really moving the needle in terms of pulling people out of poverty? Is that just a myth? Is that something that's real? Maybe you could talk to that.
Thanks, Royston. Till now, we've all been addressing access issues, saying let's get them the accounts and let's try and see how this happens. In the recent past, we've gone and done funding of 2 studies which actually sees the impact of what this is. And the first one was not in India, it was in Kenya. It's a study by Jack and Suri. Jack's at Georgetown and Suri's at MIT, where they've said that they've studied the impact of DFS, and 2% of Kenya's families, there's about 200,000 families, have moved out of poverty because of DFS. And the reason which they've gone and given is the increase in the density of agents in the neighborhood led to a couple of things. It led to a 22% increase in savings. It led to smoothing of consumption. And these are all in women-led families. And women moved out of agriculture to retail and other value-added income-generating activities. So there is a clear, evidence around that now that yes, it impacts. The other study which we went and they did was with KGFS, which was a 10-year-old study with EPOD in Harvard, which said that KGFS started their businesses identifying that in a 7-kilometer radius, there was nobody else providing services. And they took a wealth management approach, not a product-led approach, but a wealth management approach by saying to the families, what is it that works the best for you? And it's not just credit and payments. Imagine, and we also wrote about that in our report on household finance, is that when a risk is replaced with credit, it will only lead to a bad outcome. If I break my leg, I don't have insurance, I'll take a loan, I'll repay an EMI, I don't have a job just because my leg now is broken, I will get back into debt. Risk should not get replaced by credit. So just the fact that credit is available could be a good thing, but we have to see where it's being used and how it's being used. In terms of KGFS, what we've also seen is that the fact that the families which dealt with KGFS in that area, in the geography, they've seen a 3% faster reduction in poverty than they've seen in the other parts of the geography. So there is clear evidence that financial services and specifically the digital aid improvement in poverty.
Thanks. We'll come back to you, Pawan. I just want to really create that continuum in people's mind, and we have people from outside of India as well. It's really interesting to see how that has worked out. Started with the NGO MFIs when my hair was black 15 years ago. and then seeing NGO MFIs move into NBFC MFIs, and then moved to small finance banks, which we've seen in the recent past, and then Bandhan becoming a universal bank. The entry of MSME finance like Kinara, who was the first person we lent to as Grameen Impact when we launched our NBFC. So it's really interesting to see that paradigm evolve. Anuradha, what's your sense of this formalization that seems to be happening at a policy level? And how do you see really roadblocks being opened at a policy level to help this continuum? I remember talking to the central bank in Pakistan when they had NGO MFIs and then MFI banks, and very few were able to make that leap. And India had NGO MFIs and NBFC MFIs, and then they were stuck there. So each one had a missing piece. Now I think we have a policy continuum, so the NGO becomes an NBFC, the NBFC becomes a small finance bank, small finance becomes a universal. The same way for the various layers, as Hardika mentioned, within the MSME itself. So how do you see technology and policy really jiving together to make it sort of fluid?
Thank you, Royston. Actually, great question. If you look at the formalization parts of it, it's actually happened because of a government push, completely on a government push. Be it the GST, be it just like actually making sure that people register, and it's driven by the need to identify and benefit employment as well as taxation, right? So therefore, like, it is not surprising that the MSMEs by themselves do not find it like, the most happening thing for them. For them, it has meant a greater cost of compliance, and that's all that they can see at this point in time, right? Now, over time, however, and on an ongoing basis, it's actually like also creating a lot of issues around them, right? Especially with the GST, for instance, you require to trace almost the end-to-end like movement of the supply of goods, right? And the taxation that goes along with it as such. So in that context, and the amount of, therefore, the bills that it kind of generates necessitates this becoming a digital environment, right? So talking about the continuum, there is a formalization drive, and the formalization is actually continuing into a digitization methodology as well. It is actually forcing the need for digitization in a lot of these kind of enterprises. There is also a parallel drive by the government, which is to create digitization and payment trail from the perspective of a national economic benefit, in the sense that you don't want too much black money lying around and so on. So in that context, the messaging from the government has also been consistent. Now, however, having said all this, there is a continuum of policy, there is a continuum of visibility of a trail, but for the MSMEs, it has to translate into hardcore business effect, and that business effect is actually only coming from credit. Right? At this point in time, it'll be great for them to account for the revenues. What they're looking at is like, I'm accounting for my revenues and paying taxes on that. But they're not seeing the formalization actually benefiting them in the context of formal credit being available to them. Now, if that starts kicking in, then it actually like becomes a fully virtuous cycle. And therefore, like people take it on because it is necessary, not only mandatory. Okay. So that's basically where we're going with this.
Super. I mean, it's exciting because as you guys are speaking in my head, the ripples of hope keep sort of coming back and ebbing and flowing. And that word hope, H-O-P-E, really everyone's talking about a holistic solution where everyone's sort of coming together. The other one is the O, which is outcomes. And if you heard Sir Ronald Cohen speaking earlier today, but Ronnie's talking about all the time, how do we measure outcomes, result-focused. Last week again at the UN, we're talking about the SDGs really being measured. So this whole thing of measurement of outcomes is becoming critical. We at Grameen, when we set up Grameen Capital 12 years ago, was the first social investment bank. Then we want to launch last year a social debt company, probably a social equity fund, and then a social stock exchange. So we create a whole ecosystem in some ways where outcomes are critical. And in that, impact bonds. So in all of that, Pawan, how do you see, usage leads to outcomes, correct? How do you see us driving up usage in some ways so we get these outcomes that we want?
I think a great question. I think usage is driven by the fact that you're able to serve the needs of the people who you want to serve. We've unfortunately not gone and done that yet. We've we've done say that I have a product for an upper middle class or a richer middle class and saying, let me dump it down and and offer that product to an low income segment. We've not actually stepped out and say what are her needs, how do we go out and define a product, how is the product designed. Even segmentation, so to say, has been only on demographics. It hasn't been around what are the needs of its social population. Essentially what we're saying is reach has to happen first, because if the last mile is broken, it has to be a combination of high touch and high tech. It's not just only digital, and digital does not mean an absence of cash. And I'll give you an example. If you take the US itself, when they started to go electronic in their thing, they actually went and added more ATMs, right? Because there has to be a place where you're able to move cash from a phase of demat to a physical and back. And that's a phase till the time you've got an ecosystem large enough to be able to do only digital, and hence usage increases. And when we talk of usage, it's largely about usage in digital, because cash usage is still happening, right? It's not that people don't have financial lives. They all have financial lives. It's not just that it's not being tracked on the system because it's not digital. So it's a combination of access. It's a combination of products. It's a combination of new kinds of models and approaches. It's about we've till now done product-centric approaches rather than customer-centric ones. I think time is now to be able to resolve that and address that last woman standing of her needs here.
Last woman standing. Good last words. Powerful. We'll go to the last woman standing, Anuradha, and then before we throw it up to the rest. But I want to talk, Anuradha, to you about the global picture. And, really, we're talking about, Ant Finance looking at the 310, 3 minutes data entry, 1 minute assessment, 0-second disbursement. Hardega talked about 5 days. Now, we're seeing that push. We see technology capable. We're seeing big data. We're seeing AI. We're seeing machine learning. All of these things at one level can be just jargon and good to speak at conferences. The other one is really putting it into place and making it work for the customer and for that last woman we want to stand. Right now, she's beaten and not standing. So how do we really bring those pieces together? And then I will end with my HOPE acronym, because I've said only H and O till now, but just to keep you waiting and make sure you don't run away from the room. But Anuradha, your take on consumer financial, how do we just overall financial, looking at AI, big data, ML, blockchain, all the jazzy words we hear about?
You're saying last woman standing and hope in the same sentence, right? So only you can do that. But to address the question that you asked, when we, again, this is through our portfolio experience, we have actually completely rural, non-digital, feet on street portfolio of MSME lender Vistar. And there is a partially digitized lender, which is Neo Growth, where only collections is digitized, right? And then there is the full end-to-end digitized platform called Indify. So we have this whole layer of, or progression of digitized kind of lenders that we have in our portfolio. So in addition to the study, I'm also, drawing from their experience in working along with them over the years. One part of the big problem is the discovery of the MSMEs. How do you find that these guys exist, right? The second problem is, after you discover them, what happens, right? So if you look at the conversion rates prior to the digitization area, the number of people applying, if 100 people apply for a loan, it is great if 2 people get it, right? And now that's actually a much more, that's one of the things that actually Hardika also mentioned in taking from her notes as well. So one is I apply, I don't know that I will get a loan. If somebody is examining me also, I do not know at what point in time he's going to give me. What documents does it take for him to give me the loans? And why does he need these things, right? Nobody has the visibility. For the MSME, none of this is very clear, right? They just see it as a random set of document requests. that a random kind of selection process and a random kind of a dispersal kind of an effort, right? So in that, there is no trust in the financial system that can be built. Now, from there, what actually a digitization actually works for them is in terms of creating, as you mentioned, Hardika, the certainty and the timeliness of the loan, right? They require a loan not for the next, planning for the next financial year. They require a loan today because they've actually have a working capital issue, right? Somebody has not paid them. They don't know how to make up for the gap. They have to pay their vendors. Otherwise, business goes down, right? It's as simple as that for most of these guys. So it's actually necessary for them now, and it is actually that amount which is necessary. It is not 10% of that amount, right? So to create certainty and to create timeliness is one of the major components of actually how you reach out to these people. In there, the documentation and the formalization part again play a major role, because you don't need to now ask them for it. Is available for you digitally as long as you have their consent as such, right? The ability to create a full financial picture therefore improves substantially, and therefore you're able to do. What does it create? So ideally, when you talk to an MSME, the one thing that they would say is that, hey, when I think about digitization, it's about having an IT guy. Now you have an IT guy, what is the scope of work you're going to define for them? Suddenly people are very scared, right? The guy will come back and tell them, you have to use a CRM. How many business owners really know what that means, right? So the point is that none of this is actually translating into business for them. So in that kind of a context, having a WhatsApp, they've been using WhatsApp all over, but using WhatsApp for payment actually makes sense, right? It's an extension of a trusted platform that they've already used as such. So in that, there are lots of behavioral changes which are getting created, and these behavioral changes are in turn leading to tools adoption as such. So this is a very different paradigm from actually just saying that, hey, here is actually a POS machine or something else, and now you figure out what you want to do with it and reconcile with your bank account and so on and so forth. So when you see that kind of adoption, which is voluntary taking place, then I think there is a greater amount of change that you would bring into the behavior of people, and then translating therefore into a much more virtuous kind of a cycle as such.
Super. Oh, that's great. So I'm seeing these 4 trends really, and the need for a holistic solution, the outcome and the outcome measurement, the policy framework, and the ecosystem. And Lauren, to your word, hope, it's amazingly fitting as HOPE. But you talked about the challenges around regulation and the ECB, as well as the withholding tax issues. Nishit Bhai, we have the benefit of you being here, and with that we can then throw it to other questions and people. But the fact is that given your work with the government at policy level, how do you see the ecosystem evolving? We see the 2% CSR. We see, priority sector lending. Why are we sitting with an archaic definition of priority sector when the SDGs are a possible option there? Why do we sit with a set of rules in 2% CSR when you can just put the SDGs again there? So do you see that changing at an ecosystem level?
So I think on a broader level, the way in which I see, there is abundance of everything, including finance. And there is abundance of takers as well. It's just that we are not able to connect them. So we have to, I like 3 words, I think. One, you use access and behavioral thing, and you talked about tax. I think these are 3 very critical components. And the way in which I'm looking at our regulatory framework doesn't facilitate either of that. And of course, during Lehman crisis, it became very famous to say that only lawyers and accountants understand the financial products, nobody else, right? I think the same thing can be turned into, yes, even if we are, understand, if we can create access for the people, we can change the behavior. And if tax is an impediment, which is true, in a big way, yesterday Russian government also said this is one area on which Russia are agreeing. I don't know if you read yesterday's newspaper that Russia has made a big noise on tax system in India. Okay, so I think for a while, I'm very happy that it's some convergence. So I think access, okay. We need to really find new instruments. Today, just lending is old style banking.
So can I interrupt? Do you see a crowdfunding platform where Ronnie talked about really digitizing, democratizing funding access? Is that something that you see easy?
Digitization to me is only a pipeline. Okay, it's only a process or facilitation mechanism. What I'm trying to see is the end result. So here also we need to see outcome. And if everything that you do, one of the things I like, and without being religious otherwise, is even Islamic funding. Okay, if you look at, they also manipulate sometimes the way in which the Islamic funding are structured. They are loans, but they're convoluted where some people also do other things. But in principle, that is the risk taking. You don't charge interest. You find other ways of participating in the success of it may not be pure equity, it may be participating, so many other kind of instruments can be there. I think we need to find better ways, first, to structure an instrument. Then next thing, once the funding is taken by the organization or the entity, how do you change the behavior? How much focus, if you see latest readings of management books, which has just come out also, Detonate if you look at, or a Netflix book that has come out on the behavior. Even performance evaluation in the organization is not about how much revenue and what targets are met, but what the behavioral changes are there. So I think how can we change the behavior of the organization they are taking loans. And number three, if there is in India regulatory thing, I think tax is the biggest nightmare. Okay. Now, simply speaking, while the treaty is being negotiated, or it is being, a US-India treaty is getting renegotiated at this point in time, I think you must provide that if it's a US government, I would call USAID or other ones more as a developmental agency as well. If it's a developmental finance, then it should get tax exemption. It used to be there in most cases. If government-owned entities were there, like MAS at one point of time in Singapore, or those ones are tax exempt. They are more like sovereign, So it should be treated simply because it's a separate entity, because limited liability. Rest of it is all governed by most of the government.
Excellent. We had a hand up.
Sorry.
Amalu Parvatan. Yeah. Do you want to tell us, at the agricultural side, because India is still very much an agrarian economy, how do you see inclusion happening as NABARD's perspective?
Thank you very much. I would like to share a few initiatives which NABARD has taken. We are the SME finance, the financial inclusion is greatly financed by NABARD in our country. And close to $1.5 billion worth of money is given by NABARD annually. I would like to highlight some of the things, the recent initiatives that we have taken last 3 years in experimenting the digital platform for financial inclusion and microfinance. This is called eShakti.org, eShakti.nabard.org. Anybody can download. This is the digital bookkeeping for any SHG in the country. It is linked to, you can link it to your own portal, your own, you can link it to your own branch or whatever you want. And then the data is safeguarded. It gives you the tracking of every member's activity in the group, their savings, their credit, their payment, their meetings, their books, everything is included. You can sit in your office and see how your group is working. You don't need to go to the field. We have already done in 100 districts. Its pilot is this year. We are going to end in pilot districts in 100 districts. And we have asked the government to mainstream it to all districts by this year. And most probably, if government accepts, it may be coming as a budget approval for the current year, 1920. So this is going to change the whole, the gamut of things that the way we are operating. It deduplicated all the members. Sometimes the members were there in too many groups and they borrow too many areas, so they are unable to pay and all those things. So the deduplication of the members, it is deduplication of the groups that has happened. And it is Aadhaar enabled. Everybody's mobile, whosoever is having it, is onboarded. Now increasingly the other companies, corporates find value in the data to reach out to the people. So it is going to be a kind of a marketing platform for the other companies as well, in addition to the credit. So kindly, I would request all of you, somehow I feel that some resistance in this type of a group is happening, please feel free. It is a free, as of now, it is absolutely free for all.
No resistance, all inclusion. Thank you for giving us your comments.
One more thing I would like to say is that we need to understand, because there was a lot of discussion about financial inclusion and MSME. For my 32 years of service looking into this financial inclusion, or even 92 onwards, we are doing, I don't accept microfinance, enterprises have come just like that. Initially, it started with the individuals with the small means, which cannot be accessed individually. They went into a group mode. Then, when they scale up, so there is a life cycle involved in this. Therefore, this platform, the SDG platform that we have created, also lead to life cycle upscaling into enterprises, because the activities are known. We are trying to federate them into a bigger activity, taking economic activity
wonderful.
to MSMEs.
The ecosystem
So it's
point
a huge,
is exactly
huge platform.
that.
Please
Exactly.
accept it.
Absolutely.
And I'm telling you, whether you like it or not, 3 years down the line, all of you have to be on the board.
We like it. We like it. Thank you. Jairupa.
Thanks so much. That was a very good point on thing, and noted. And thank you, speakers. We would have loved to take some questions, but we're running out of time. The speakers are available after this as well, and could probably take some of the questions offline. But I must thank the speakers. Very interesting panel. We actually saw the flow of funds all the way from DFIs going to GPs, and then into supported by an investment banker here in the room, and finally to the entrepreneur itself. It was also good to hear about the initiatives taken by the government in cooperation with the Gates Foundation as well. So very interesting discussion. Thanks so much, and thank you for the inputs, Mr. Nishit, and you as well. Thanks so much.